15th Finance Commission has given its report. Questions have been coming in the prelims and they can again come. So Finance Commission is constituted by the President after every 5 years under Article 280 of the Constitution. So Finance Commission is a statutory body. No, it is not a statutory body. It is a quasi-judicial constitutional body. It is a constitutional body. Its report is only advisory, not binding. However, by convention, government usually accepts all the recommendations of the Finance Commissions. Members are eligible for reappointment. The first Finance Commission was constituted in 1951 under Shri K.C. Niyogi. The qualifications and the selection procedure are not given in the Constitution. They are decided by the Parliament. Hence, Parliament made Finance Commission Act 1951. UPSC will say that who all are part of the selection committee for Finance Commission. So remember, there is no selection committee. Okay, there is no selection committee. Whoever government wants can make. The chairman should have experience in public affairs. The 4 members, one should be High Court judge, either retired or serving, or should be qualified to be a High Court judge. 1 member should have knowledge of finance, 1 should have knowledge of economics, and 1 should have experience in financial matters and administration. What is the main purpose of creating this Finance Commission? The main purpose is to tell that how should the taxes be distributed between the center and the states. What should be the principles based on which grants should be given by the center to the states. What steps can be taken to augment the funds of the state to support the local bodies like panchayats and municipalities, and any other matter that the president may refer. You should know for your prelims examination the name of the chairman of the last 3 finance commissions. 13th Finance Commission was headed by Dr. Vijay Kelkar, 14th by Dr. Y.V. Reddy, and 15th by N.K. Singh. The 15th Finance Commission is special because it is for the first time that a Finance Commission has given recommendations for 6 years. Normally it gives recommendations for 5 years because this Finance Commission gave 2 reports. Initially it gave a report for 1 year and now it has given another report for 5 years. So total 6 years. The report is submitted to the President, who causes the reports to be laid in both the houses of the Parliament along with a memo which says basically that what action the government has taken on the report of the Finance Commission. When the President constitutes the Finance Commission, then obviously these are the things that Finance Commission has to look into. Other than that also, the government usually tells that you have to look at some other things also. For example, in the terms of reference of the 15th Finance Commission, it was given that you have to review the debt level of the center and states and recommend a roadmap to improve it. You have to recommend that how can we give performance based incentives to the states. That is, which state will perform better should get more funds. What has been the impact of GST on the economy? And you need to also suggest a mechanism for funding the modernization of the defense forces. Do you need to learn all these things? And what about the recommendation? Are these necessary for a prelims examination? Don't ratify them word to word, but read them 2-3 times so that if UPSC gives any sentence as it is, you should be able to recognize it. In the past, whenever the reports have come of the Finance Commission, UPSC has asked question in prelims about the terms of reference or the recommendations. Those questions I will just show you on the next page. Vertical devolution, 41% of the taxes should go to the states. Earlier it was 42%, now it is 41%. Why reduced by 1%? Because now Jammu Kashmir is a union territory. Earlier 1% used to go to Jammu Kashmir, but now it is a union territory, so the central government will have to spend that money. Right? So therefore the state's share has been decreased by 1%, which is obvious. Now once you have given 41% money to the states, all states are not equal. Some are big, some are small. Some will need more money, some will need less money. So how do you divide the money among the states? That is called as horizontal devolution criteria. Now there are different criterias here. Okay, just read their names. Income distance is a criteria, Population based on 2011 census. Remember the year. Area, forest and ecology, demographical performance, and tax effort. What is the meaning of income distance? Income distance means that how much is the distance between the per capita income of a state and that of the state with the highest per capita income. That is the meaning of income distance, right? Again, don't learn any figures, just read them 2-3 times. About the local bodies, the grants should be given to all the tiers, all the 3 tiers of the Panchayati Raj institutions, and between the rural and the urban bodies, the ratio should be 67:5, 67.5:32.5. About disaster management, India already has disaster relief funds, but we don't have disaster mitigation funds. So it has suggested we should have disaster mitigation funds at national and state levels. Why mitigation? So that when disaster happens, we should be well prepared. The impact of the disaster should be minimum. Again, this ratio of 75:25 is not relevant for your prelims examination. About the financial management, it has given some targets, but these targets are not relevant. Still, you can read them. The fiscal deficit target for central government is 4% of GDP by 2026, and for states it is 3% of state GDP by 2023. There should also be an independent fiscal council to assess the financial records of the central government and the state governments. In the terms of reference, it was given that there should be a funding mechanism for modernization of defense forces. So the Finance Commission has said there should be a non-lapsable modernization fund. What does it mean? Suppose in a particular year, the budget has allocated rupees 5,000 crore for modernization of army. But that particular year, army could utilize only 3,000 crore rupees. So the remaining 2,000 crore rupees army will not get because it has not been able to utilize it, right? So that is a lapsable fund. In case of non-lapsable fund, the 2,000 crore rupees will carry forward to the next year. For health, it has recommended that there should be a all India health service and the states should spend at least 8% of their annual budget on the health sector. Now some previous year questions related to the Finance Commission. In 2010 and 12, UPSC asked who causes to be laid the reports of the Finance Commission in the Parliament. The answer is President of India. In 2000, 2003 and 2011, all 3 years UPSC tested whether you have properly studied the functions of the Finance Commission, the 3-4 functions that I gave on the page number 1. Okay. So question of 2000, the primary function of Finance Commission is to about the distribution of revenue between the center and the states. 3 years later, again a question came. The function is to distribution of taxes between center and states, and second is about the grants in aid from the state. So basically, states give application to the Finance Commission that we should be given so much grants, and obviously Finance Commission is used to will study all those applications and finally come to a conclusion that such and such should be the criteria for giving grants to the states, right? Same thing. So 2 and 3 are correct. 1 and 4 are wrong. 1 says that it allows the withdrawal of money from Consolidated Fund of India. No, that is done through the appropriation bill, right? So 1 is wrong. Again, 4th says that it supervises whether the states are using the money or levying the taxes properly or not. No, that is not the work of Finance Commission, right? Just remember, UPSC can frame hundreds of sentences like this. You can't remember all of them. Just remember the 2-3 functions that I gave to you on page number 1. 2011 question. Finance Commission encourages FDI. It distributes the money between the PSUs. It ensures transparency in the financial administration. Nothing like this. These are not all the functions of Finance Commission, right? Have your concepts clear. 2010 and 2011 question were about the State Finance Commission. 2010 question. It is the State Finance Commission that recommends to the governor how much money should be given to the panchayats. 2011 question was a bit different. Here UPSC asked that Which of the following institutions were created by the 73rd Amendment Act 1992? State Election Commission, right. State Finance Commission, right. District Planning Committee, no. As per the official answer key given by the UPSC, first is also correct. That is, District Planning Committee were also formed according to the 73rd Amendment Act, but that is wrong. District Planning Committees were formed according to the 74th Amendment Act. Okay. 2012 and 2015 UPSC asked about the recommendations given by the 13th and 14th Finance Commissions. So you should be able to identify that among these sentences, which of the sentences we have read in our material and which UPSC is creating out of its own mind. Like in 13th Finance Commission, it had recommended about a proper design of the GST, what should be the structure of the GST in India. It also recommended that how much taxes should go to the local bodies. But 13th Finance Commission never gave any recommendation like how the government should create lakhs of jobs, right? So that was wrong. So that sentence UPSC created out of its own mind. So second is wrong, first and third are correct. 2015 question on 14th Finance Commission's recommendation. It increased states' share from 32% to 42%. That's right. Secondly, it made recommendation consider about the sector specific grant. So actually that year it was in news that every year generally finance commissions gives recommendation about sector specific grants. But the 14th Finance Commission did not give any recommendation about the sector specific grant. Therefore UPSC asked this question. So for this exam, just remember that 13th and 15th Finance Commissions have given recommendation for the sector specific grant, but the 14th Finance Commission did not give any such recommendation. About the grants recommended by the 15th Finance Commission, don't learn these figures, but remember the headings. The headings are 15th Finance Commission has recommended grants for local bodies, revenue deficit grant, disaster management grant, sector specific grants and state specific grant. The highest grants are for local bodies. Okay. Among the sector specific grants, the highest grants, most grants will go to the health sector. Finance Commission has given some recommendations to streamline the expenses on the centrally sponsored schemes, but they are not relevant for your prelims examination. For prelims, you should know the difference between the central sector scheme and the centrally sponsored. Central sector schemes are totally funded by the center and they are implemented by the center. Similarly, the state schemes are totally funded and implemented by the state. However, there are some centrally sponsored schemes. They are implemented by the state, but they are partially sponsored by the central government. Right? So here the expenditure is shared. In India, we have approximately 35 centrally sponsored schemes, out of which 6 are core of the core. They are very important for us, and those schemes are like National Social Assistance Program or Manrega. Right? Government of India considers that these schemes are extremely essential for our country. Then we have around 27 core schemes. We are talking about the centrally sponsored schemes. There are 27 approximately core schemes in which 60% money comes from the central government and 40% comes from the state governments. For Northeast and Himalayan states, the ratio is 90:10 because these states have less revenue. Then there are 2 optional schemes. If the states want, they can implement them. If they want, they can skip them. Capital gains tax. Suppose you think that along with preparing for the examination, you will do a small business. You will purchase copies for ₹100 and you will sell them for ₹120. So this is called as trading. This is not capital goods. You are not buying the capital here. You are simply buying something and selling it and earning a small profit. So increase in the sales of a product is not a capital gain. Capital gain arises when you invest and then sell a capital good. A capital good or a capital asset is like a property or a vehicle, any patent, trademark, any machines in your factory, jewelry, all these are capital goods. If you want to invest money in a company, either through equity or through debt by buying its bonds. That is also a capital investment in the company, right? So when you purchase a painting, a very famous painting, right, and after some years you sell it because its value has increased, so there also you're making a capital gain, right? So when you buy a capital asset and then you sell it, whatever profit you are making, that profit is taxed separately, and that is called as capital gains tax. Please remember that when you inherit a property, you don't have to pay any capital gains tax, but when you sell it, then at the time of sale you have to give the capital gains tax, because by selling you are making a monetary profit. Okay, 2012 question is clear. Same thing about the that's increase in sales is not a capital gain, but increase in value of property and painting, they are capital gains. Now capital gains are also taxed differently. The biggest differentiation is for how long you held that thing. Suppose you buy a house and you sell it within 2 years, then short term capital gain tax will apply. If you sell it after 2 years, then long term capital gains tax will apply. The rates are different. For short term, maybe it is 10%. Okay, 10% of the profits you have to give as tax. For long term, maybe it is 15%. That depends, right? So in the case of shares and bonds of the company, it is 1 year period. If you sell the shares or bonds within a year, you have to pay short term capital gain tax. If you sell it after 1 year, you have to give long term capital gains tax. For immovable property, it's 2 years, and for other things, it is 3 years. You sell it within 3 years, short term capital gain tax. Sell it after 3 years, then long term capital gain tax. Equalization levy we had studied on page number 14. On page number 24, we studied about the DFI, Development Financial Institutions. Banks perform different functions, and for each specific function, government is trying to set up dedicated banks. Hence, development financial institutions give long-term loans, and they take deposits also for long term. They don't take demand deposit that public will go and deposit the money and take any time. No, they don't take money from the public. So IFCI was the first DFI in India, established in 1948. So DFIs give financial and sometimes technical support also. They give loan for the medium and long term. They don't directly take funds from the people. In India, the first DFI in independent India was IFCI in 1948. Then in 1955, we formed ICICI. The ICICI Bank, the bank was formed in 1994 at Vadodara in Gujarat. But ICICI as a development finance institution of the private sector, the first in India, the first DFI in private sector in India, that was formed in 1955. In 1964, IDBI. In 1971, IRCI, that is Industrial Reconstruction Corporation of India. You have to learn the years, because in 2002 also UPSC had asked about the years of establishment of IFCI, ICICI and IDBI. NABARD we had already studied. It was established in 1982. Now about the NABFID that the government has established. NABFID is a statutory body set up under the NABFID Act 2021. According to this act, these are some features, these are some points that I have extracted from this act. So UPSC can ask these things, right? So as per this act, NABFID will have headquarters in Mumbai. Initially, it will be 100% owned by the central government. Later on, central government can dilute its share up to 26%. Okay, at any given point of time, central government should hold at least 26% in NABFID. Chairperson will be appointed by the central government after consulting RBI. Authorized share capital will be 1 lakh crore rupees, and within 1 year of establishment, central government has to give 5,000 crore rupees. Other DFIs in future, they can be set up simply by applying to the RBI. RBI will give the license to the new DFIs. NABFID, statutory body under Department of Financial Services under Finance Ministry. It has two objectives. The financial objective is to give money or somehow arrange money for the big infra projects. And the development objective is to develop the bond market or the derivative markets in India. So like earlier I also explained to you that the bond market in India are not well developed. Government is trying to develop the corporate bond market in India. So NAFED also has an objective to further develop the financial markets in India like bond market and derivative markets. From where will NAFED get the funds? NAFED will not take funds from directly from the people. Okay, it can raise either rupee or foreign currency from the government, RBI, banks, mutual funds, or World Bank, or many other sources. Remember, not from the public. On page number 31, we had already studied few things about RBI. Now let us see about the Regulations Review Authority constituted by RBI. So RBI is a regulator. RBI needs to review that how it can better improve its regulatory function. For that, it has created an advisory body, that is Regulations Review Authority. Earlier, RBI constituted RRA in 1999, and now the RRA has been constituted under Deputy Governor M. Rajeshwar Rao. Please remember that there are other regulators also in India. This Regulations Review Authority is not going to review the regulatory functioning of all the regulators. It is going to review the regulating functioning only of the RBI. Some of the reports that RBI brings, some of the famous ones are Consumer Confidence Survey, Inflation Expectation Survey, Financial Stability Report, Monetary Policy Report, and the report on trend and progress of banking in India. Some other regulators. You should know about the year of establishment of the regulators. Like the telecom regulator, TRAI, was established in 1997. Petroleum regulator was established in 2006. Electricity regulator initially constituted in 1998, and then a new act came in 2003. So both these options, any one of these UPSC gives, mark them as correct. And the four financial regulators: RBI in 1934, SEBI in 1992, IRDA in 1999, and PFRDA for pensions in 2013. What is the need of regulators? Take the example of telecom sector. Initially there were only BSNL and MTNL. These are government companies. Now government will never exploit the public, right? Government is answerable to the public. But when government opened the telecom sector for the private companies, then obviously there is always a fear that the private companies may exploit the people. They may bend the market in such a way that the companies will earn a lot of profit and people will suffer. So to protect the public interest, government creates regulators, especially when the private sector is allowed to enter any particular industry. Suppose you have some complaint from your bank. You have made repeated complaints even to the senior management, but the bank is simply not resolving your complaint. In such a situation, you will feel like going to a court. But court cases go on for years and it is very cumbersome, also not practical. Therefore, there is a concept of ombudsman, whereby the government or that sector's regulator creates an independent body, right? That is called as a ombudsman. For example, for the banking sector, RBI has appointed a banking ombudsman. They are for other sectors also. Like there is an insurance ombudsman appointed by the IRDA, right? So for banking, RBI has appointed banking ombudsman so that customers can take their complaints to the ombudsman when the bank is not listening to them. So ombudsman is basically like a alternate dispute resolution mechanism. Right now in India, there are more than 22 offices of the banking ombudsman. So this particular scheme for banking ombudsman was introduced in 1995 under section 35A of Banking Regulation Act 1949. The scheme was revised in 2006, and the scheme that is currently going on is the 2006 schemes. Many banks are included in this. For example, commercial banks, RRBs, cooperative banks, they all. Now the news is that RBI has said that right now we have three different ombudsmen. One for complaints against banks, another for complaints against NBFCs, and third for complaints against digital transactions. RBI is saying that we are going to merge all the three ombudsmans. In 2018, RBI said that the central ombudsman is getting quite loaded with the cases, so each bank should also create an internal ombudsman within the bank to listen to the grievances of the people. Now look at the previous year question of 2010 about the banking ombudsman. Which of the statements are not correct? First is that he is appointed by the RBI. That's correct. Second, NRIs can also complain. Yes, of course. If an NRI has a bank account in India and is not getting proper service, there is some complaint, obviously he can also approach the ombudsman. No issue in that. The service provided are free of charge. That's right. When you're going to the banking ombudsman, you're filing a complaint there, you won't be charged any fee. Okay, it's totally free. So these three statements are correct. What is incorrect is that the orders of the banking ombudsman are final and binding. This is wrong. If you are not happy with the the orders of the banking ombudsman, the decision of the ombudsman, then you can approach the deputy governor of the RBI allocated for this specific work. Neobanks are not banks. They don't have any banking license from the RBI. Still they are providing you banking services. How can they provide you banking service without having a banking license? Because they have tied up with the actual banks. See, neobanks are basically fintech firms. That is, those technology firms who use latest digital technologies to deliver some financial products to you. For example, this is you and you had a bank account, but you are not happy with the services of the bank. Bank has provided you mobile banking, internet banking, everything, but you're not happy with the services of the bank. So a middleman will come. This middleman is a fintech firm. This fintech firm will tell you, neobank will tell you that you open your savings account with us, you open your current account with us. If you want to collect payments from many people, okay, we will help you in collecting the payments also. So we will provide you many services. Simply you have to download our mobile application and everything will be done sitting at home. So you will be very happy. You will open an account with them, but they don't have a banking license. So what they are doing is they have tied up with a conventional bank, right? So here you are happy, you are getting all the banking services easily. This new bank is happy, they are earning some commission in it, and the bank is also happy because it is getting lots of business without having to entertain the customer, right? So that is the concept of neobank. So for prelims, just remember that neobanks do not have banking license, but they provide you with the banking services. Some examples are Razorpay X and Neo. RBI has said that from December 2021, it will start the pilot project on digital currency. China has already issued a digital currency. To understand this, first we need to understand what is legal tender that was asked by UPSC in 2018 paper. So legal tender means any currency which has been recognized by law and any citizen cannot refuse to take it. If you have purchased something and you want to pay it in gold coins, and the other person, can he refuse that I do not take payment in gold? Yes, he can refuse, right? So therefore this is not a legal tender. If you're trying to give a check, other person can refuse. He can say that I don't have a bank account, so I don't take a check. So check is also not a legal tender. But if you pay in coins or notes, then he cannot refuse. He cannot say that I will take only dollars, right? So these currency, this rupee, your notes and coins, these are legal tender because the other person cannot refuse to take it. So that is the answer to your 2018 question. Now what is fiat money? You must have heard many times that on the rupee note there is written that governor has written, I promise to pay the bearer this much. So you must have heard many times that when RBI prints the money, then it has kept an equal value of gold in its reserve. But that is the old concept. Now that does not happen. Earlier what used to happen is if RBI had to print some money, then it had kept in its reserve equal amount of gold. Now RBI is not compelled to do so. Now RBI can simply print as much money as it wants. It is not backed. The rupee that we have in our pocket, it is not backed by gold. It is backed by government's promise, right? It has no intrinsic value. This is a piece of paper. It has no value of its own. It has value because there is nature of the RBI. This coin has no value on its own. It has zero intrinsic value. It has value because the government of India has said that this is a 10 rupee coin. Gold coin? Gold coin has intrinsic value. Think like this, simple funda. Take a pen and with that pen you cut that 100 rupee. Then what is the value of this? It has no value because it has only face value. What is written on its face? If it is written 500 rupees, then it is worth 500 rupees. Similarly, this coin, if you cut 10 rupees here, then it has no value. It has only face value. Similarly, this gold coin, one is written, 1 grams is written on this gold coin. You take a pen and you cut this 1 gram. Then will it have any value? Yes, because it is still gold. So gold has intrinsic value. Gold has value of its own. But rupee and coins, these things, notes and coins have face value. What is written, that is there. Right? Gold need not be backed by any RBI or any government. Gold has its own value. Fiat money, this is fiat money. Fiat money has no intrinsic value. It has no value of its own. It is valuable only because it is backed by the government authority like RBI. Okay, now remember that it is not backed by any gold. So when RBI is issuing the money, it need not keep any gold in its reserves. Problem is that RBI can print as much as it wants. If today RBI wants to print 1 lakh crore rupees, it can simply print 1 lakh crore rupees. It will not need to create equal amount of gold in its reserve. Coins are issued by the government of India. Notes are issued by the RBI. But 1 rupee note is issued by the government. It has sign of the finance secretary. Now what is the digital currency? It is same. It is the same fiat currency. The only difference is that it is issued in a digital form. See, RBI has a printing press from which it is printing the notes. Now when RBI will issue a digital currency, what it will do is, instead of a printing press, it will install a computer in its office. In that computer, RBI will open a folder. In that folder, RBI will create a files, and RBI will give names to the files. On this file, RBI will write rupees 500 and some serial number. Like on a rupee note, you have 100 rupees and a serial number. Same thing. Similarly, 500 rupees, another file of 500 rupees and another unique code like this. After this printing, RBI has signed on it. Governor has signed on it. Similarly, on these files, digitally signed, digital signature will be done by the RBI. So these are digital currency. Just like you transfer your cash, you take out from your pocket and you give your cash to another person, the cash goes in his pocket. Similarly, you cannot have this digital file in your pocket. You can have digital files in your computer or your laptop or your mobile device. So you will transfer these files. You will either transfer these files through email or through pen drive, anyway, right? These are simply files, or through Bluetooth also, right? So these are just like your rupee, only in the digital form. They are exchangeable on one-to-one basis, and they can be spent only electronically. You cannot withdraw them from the ATM. Understand the concept here. Suppose you have some dollars with you. Can you withdraw dollars from the ATM? No, you cannot. First, electronically you will convert the dollars into rupees, and then you can withdraw from the ATM. Similarly, if you have some digital rupee with you that RBI will issue in the future, those digital rupee you cannot withdraw from the ATM. First, electronically you convert, you exchange, just like you exchange dollar to rupee, similarly you have to exchange these digital rupee with the physical currency online, and after that online conversion, then you can withdraw the physical rupee from the ATM. Okay, the only difference here is the exchange rate. In case of rupee dollar exchange rate, the rate is 75, but in case of digital rupee and physical rupee, the exchange rate will be 1 rupee, will be 1. That is 500 rupees digital means 500 rupees in the cash. Now there is a confusion between the virtual currency and the digital currency. The simple thing is, these digital currencies are are they being controlled by the RBI? Is RBI regulating them? Yes, if RBI is any central bank is regulating them, then we call them as digital currency. If any central bank is not regulating them, then we call them as virtual currency. Okay, that is the only difference. Now once you have created them, obviously there will be a issue of fake currency. Just like we have fake rupee note, there can be fake files also. You are very intelligent, you had a printer in your home, you tried to print fake notes. Now people have computer, they will try to print, make fake files. So how do you secure them? How does RBI secure the notes? By increasing the security features like ink or watermarking and other things. Similarly, RBI can use, central banks or anyone can use different technologies to secure these files. Right? If you are using cryptography, to secure these files, then they are called as cryptocurrencies. Now one technology in cryptography is blockchain. If you are using blockchain to use cryptography to secure these files, then they are called as cryptocurrency using blockchain. So these are just technologies how you are going to secure your files. Okay, so what is Bitcoin? Bitcoin is a cryptocurrency which uses blockchain to secure itself. But it is a virtual currency because it is not regulated by any central bank. Okay, in India, cryptocurrencies like Bitcoin are not banned. At few years ago, they were banned for a small time, but now they are not banned. You can use Bitcoins in India, but they are not legal tender. They are not legal tender. You are using them at your own risk. If the other person is ready to accept, then you can pay. You cannot force anyone to use Bitcoin. So China has issued digital renminbi or digital RMB or ECNY, that is electronic yuan. It is the first major economy to issue a digital currency. It is a legal tender, obviously, and it has the same value as the physical renminbi. It can also be transferred between two offline devices. Like I told you that if you have a pen drive, you can send these files through pen drive to another person. You need not have any internet connection. If you have two mobile devices, you can send it through Wi-Fi transfer or Bluetooth transfer, anything like that. El Salvador is the first country in the world to give legal tender recognition to Bitcoin. In Japan, Bitcoins are not legal tender. They are legal property. Japan has recognized Bitcoins as legal property, not as a legal tender. E-rupee has been launched. It has already been launched, but it is not a digital rupee, it is not a digital currency, it is not a virtual currency. It is a voucher. It is simply a voucher which is person specific and purpose specific. Suppose the government of India wants to give free vaccination to this person. Now there are two methods. Either the government of India will give 700 rupees to this person in his bank account, or the government of India can give 700 rupees to the hospital and say that such and such person will come, you give him free vaccination, we are sending you the money. These are two methods, but they are prone to corruption. So a solution is to use e-rupee or a voucher system. Here, government of India will give 700 rupees to a bank, and along with that, government of India will tell to the bank that these 700 rupees are for this particular person with this particular mobile number. Bank will generate a secret code and send as SMS to this person on his mobile phone. This person will go to the hospital, show the SMS. Hospital will enter the SMS code on their laptop and electronically send it to the bank. Bank will say that we have got a code from the hospital which we had sent to this person on this mobile number. The code and the mobile number are correct. Therefore, we are sure that the person has reached the hospital. So the bank will give the 700 rupees to the hospital that the bank had got from the government. Right? So this is a voucher system. E-rupee is a voucher system. It is not money. It has been developed by NPCI. Okay, the person can have even a basic phone which can receive SMS, then also it will work. Please remember that this e-rupee system is not restricted only to the health sector or to the government sector. Even private sector can use it. Government has created, NPCI has created this system. Now even private companies can use it. A very interesting example, just 1 minute it will take. It is not government. Suppose it is a private company. Private company will give money and mobile numbers to a bank. Those mobile numbers are of the truck drivers, right? SMS will go to the company's truck drivers. When the truck drivers will go to the petrol pump, instead of paying money, the truck drivers will simply show the SMS code. Petrol pump will enter the SMS code and get money from the bank, right? So without any need of exchange of money, the company can plug the leakages at the petrol pump, right? So even private sector can use this system. It is not restricted to the government sector. In the last 6 months, government has brought 2 amendment acts in the insurance sector. Okay, so insurance is a bit important for examination. The concept of insurance is very simple. Suppose there are 10 people, all of them own a car. Now they are afraid that in case their car gets damaged in an accident, there will be a huge cost to repair it. So what these 10 people decided, they keep a box in the middle and they decide that every year each one of us will put some money into this box, right? And we will not take out this money, we will just keep it there. Let us say after 3 years or 4 years or 5 years, if any one of our cars meets an accident, then to repair that car we will give the money from this box. That is the concept of insurance. Now the point is, this money is sitting ideally here for the next 3 or 4 years. And who is going to go to each one person and collect the money? You need some professional for this. So you outsource this work of collecting the money and investing it in some bank or anywhere, so that this money is not ideal for the next 3 or 4 or 5 years or 10 years. It grows also. So that is the work of an insurance company. So when you purchase an insurance, you pay some premium to the company. You pay the premium, you will not get it back. You have simply paid it, right? So insurance company has got premium from many people. Right now, insurance company has lots of money. It will invest that money, instead of keeping it idle in a box, it will invest that in stock exchange, on the equity, bonds, InvITs, REITs, etc., mutual funds. In many places, insurance company will invest it, and this money will keep on growing. So now insurance company has lots of money. Out of all the people who have contributed the premium to the company, if any one of them, any 1, 2, 3, how many of them meets an accident, their car meets an accident or they die or whatever, then the insurance company will use this money to pay to that person. Same thing, right? The thing here is that if 100 people are giving car insurance money to the insurance company, then all 100 people will not suffer an accident. Out of 100, only 2 or 3 will suffer an accident, but money everyone is paying, small money, right? So that is the purpose of insurance, that many people are contributing and the one who is in need will get the money. So if UPSC says that insurance companies can invest the premium they have got from the people into an equity of a company, yes, they can, they do it, they invest all this money in different places. Just like the government of India had nationalized the banks in India, similarly the government had also nationalized the insurance companies. In the year 1956, Government of India nationalized all the life insurance companies, combined them into a single company called as LIC, Life Insurance Corporation of India. Similarly, in the year 1972, Government of India combined all the general insurance companies and formed a single company called as GIC, or the General Insurance Corporation of India. Life insurance means if you die, your nominee or the next person will get the money. General insurance is about the all other insurance, like your health insurance, mediclaim, that is your house insurance, car insurance, everything. All that is general insurance. So this was done by some acts of the parliament. So Jibna Act 1972 nationalized the general insurance sector in India. It created GIC, and of GIC it created 4 subsidiary companies. Okay. The name of those subsidiary companies are National Insurance Company, New India, United India and Oriental Insurance Companies. Out of these four, New India Insurance Company today is the only company which is listed. It is the only among these four. It is the only company which is listed on a stock exchange. Through this Jibna Act, it was also written that since these are government companies, government should at no time bring down its stake below 51%. That is, they should always remain. These four companies should always remain government companies. In the year 2002, government made a small modification. Government said that from now onwards, these four companies will not remain the subsidiary of GIC. GIC will be separate and these companies will be separate. So GIC was made the reinsurer and these four continue to be government insurance companies in the general insurance sector. What is the meaning of reinsurance? Insurance companies also, just like you are getting insured from the insurance company, these companies are also purchasing insurance from another company that is called as a reinsurer. So GIC of India right now is a reinsurer. Now why are we studying all this? Because government has brought some laws. Government has said from the March 2021 law, Insurance Amendment Act 2021, government amended the 1938 Insurance Act and said that in insurance sector, FDI has been increased from 49% to 74%. Similarly, in August, government brought a law which amended the Jibna Act of 1972. 1972 Act said that government should have at least 51% stake. This amendment says government can reduce its share below 51%. Okay. So the combined effect of these two laws is that now these government insurance companies can be privatized, and not only privatized, but these government companies, national companies, will become foreign companies and you can't stop anything. They will become, they don't even need government's permission for this. Okay, government will simply dilute the stake and any foreign company will increase its stake and they will become foreign companies. So in the life insurance sector right now, LIC is the biggest player. Okay, LIC is a market leader. LIC has a huge market share. But in the general insurance sector, these companies are working good, no doubt, but private companies are also there and they are giving a tough competition to these companies. Okay, so there was also news that LIC is very profitable. Out of all the insurance companies in India, LIC seems to be the most profitable. It is extremely wealthy. It has huge amount of money, and government is going to sell its some stake in LIC, and through IPO, government expects to fetch at least 1 lakh crore rupees by selling a part of a extremely profitable company. Now look at the previous year questions on insurance sector. 2006 question. LIC is the oldest insurance company? No. LIC was formed in 1956, but National Insurance was formed in 1906. So first is wrong. Second says National Insurance Company was formed in 1972. Yes, that is right. Through the Jibna Act of 1972, these four companies were formed. United India has headquarters in Chennai. Yes, that is correct. 2009 question. Okay, so in this question, UPSC basically asked about the chronology. Nationalization of insurance in 1956 and 1972. Nationalization of State Bank of India 1955. Banking Regulation Act 1949 and first 5-year plan in 1951. After 9 years, again UPSC asked a chronology based question. First communist government was elected in 1957. It was in Kerala. Imperial Bank of India was nationalized into State Bank of India in 1955. Air India was nationalized in 1953 and Goa became part of India in 1961. In the last few years, many of banks in India have either failed or they have gone into moratorium. Therefore, the faith of the public in the banking sector has decreased. Therefore, in 2020, Government of India increased the deposit insurance limit from 1 lakh to 5 lakh. Still after that, a few more banks failed or were put under moratorium. Therefore, now the government has brought a new rule that within 90 days of a bank being put under moratorium, people will get the money. What it is, I will explain to you. But for the time being, just understand that people's faith in banking system is extremely important, because if people lose faith in banking system, if people don't put money in the bank, then bank will not have any money to give as loan, and when there are no loans, then the economy will not work, right? Now about the deposit insurance. What happens is, this is a central insurance company, DICGC. Just like we studied about insurance now. So consider that DICGC is an insurance company and there are many banks. These banks are paying some premium to this insurance company. Why? So that in future, if any of these banks fails, then the depositors, the general public who have money in the bank, they will get money from DICGC. So DICGC is a statutory body formed by DICGC Act 1961. It is fully owned by Reserve Bank of India. How much premium the banks are paying? 12 paise per 100 rupees. That is, when you deposit 100 rupee in your account, then the bank will pay 12 paise to DICGC. And this 12 paise the bank has to pay from its own pocket. Bank cannot tell to you that, sir, I am getting your 100 rupees insured, therefore now your account has only 99 rupees and 88 paise. Bank can't say that. Bank has to give 12 paise from its own pocket for this insurance. Okay. This insurance, this is called as deposit insurance. This is applicable for the general public. Suppose this bank has failed. The general public had money in it. So DICGC will give money to the public. Suppose Government of India also had some money in this bank, or another banks had money in this bank. DICGC will not give money to these people. It will give money only to the general public, right? Now what used to happen is, when a bank failed, suppose a PMC bank, it was not closed down immediately. The rule earlier was that when a bank is closed down, then the depositors will get money from the DICGC. But closure of bank legally takes lots of time. In the meantime, banks are put under moratorium. Moratorium means there is a pause. There is a pause button is put on the activities of the bank. For example, PMC Bank, around 2 years ago it failed, but it has not been closed down. It has been put under moratorium. So people are saying that we want our money from DICGC, but DICGC is saying that we will give you money only after the bank is closed down. Right now it is not closed down, it is simply under moratorium. So people are not able to get their money from DICGC. Now, to increase people's faith in the banking sector, government has said that even when a bank is put under moratorium, you will get your money from DICGC within 90 days. This is the new law. Okay, excellent thing. Now it is hoped that since so many banks have been failed and they are under moratorium, very soon people will get the money. The limit here is up to 5 lakh rupees. Okay, that means if you have, let us say, 2.7 lakh rupees in a bank and the bank goes bankrupt, then you will get 2.7 lakh rupees. If you have 5.3 lakh rupees in your bank account in SBI and SBI fails, you will not get 5.3 lakh rupees from DICGC. You will get only 5 lakh rupees from DICGC. That is the meaning of the upper limit. Also, this limit, it combines all the bank accounts in a particular bank. This limit is 5 lakh rupees per depositor per bank, including all the accounts in that bank. You are a rich person, you have 25 lakh rupees. You have an account in SBI, savings account. You put all your money in the savings account. SBI fails, you will get only 5 lakh rupees from DICGC. You think that instead of one saving account, I will create 3 or 4 savings account in SBI. I will also open 2 current accounts. I will also open 10 FDs. It does not matter. When SBI will fail, all the money in all your accounts in SBI will be combined to calculate the limit of 5 lakh rupees. So solution is that open your bank account in some other banks also and distribute 5 lakh rupees in each account in each bank, then your whole money can be secured. So this limit is per bank per depositor, and both your principal and interest are covered, right? When you put money in your bank account, you earn some interest also on it, so everything is covered. You don't have to worry about that. Okay, so This is covered. So this is compulsory. Okay, deposit insurance is compulsory, and all banks have to deposit this money with the DICGC. Earlier, only liquidation was a condition. Now, even if a bank is put under moratorium, within 90 days, people will get the money from DICGC. Digilocker. Digilocker is just like your Google Cloud, just like your Google Drive. It is a cloud-based solution. Suppose CBSE has issued you mark sheet or RTO has issued you driving license. So you create your Digilocker account and they will upload the documents there, right? And tomorrow if your college wants to verify your 12th mark sheet or police wants to verify your driving license, they can open your Digilocker account and see that, verify that. So it is an initiative of MeetY. It is a cloud-based platform where someone can verify the authenticity of the documents. They are at par with your physical documents. Okay, your physical documents or this. You can't, police can't say that we want only physical driving license. Okay, even this will work. This is as per the Information Technology Act 2000. You can also yourself upload some documents. Okay, and you can e-sign them, just like you have your self-attestation. You get some photocopies and you self-attest them. Similarly, you can upload some documents and you can self-attest them. The 2016 question, Digilocker is a digital locker. Fine. You can access your e-documents irrespective of your physical location because it is based on the internet. It is cloud-based. On page number 33, we had already studied about the umbrella entity for payment system, NPCI, and related things like Payment Infra Development Fund, merchant discount rate, difference between IMPS, RTGS and NEFT. Now there are some additional things like UPSC can ask what has been the trend in the number of digital payment transactions and their value in the last few years. So remember, the trend has been of a consistently increasing line like this, both the value and the volume. Okay, there has not been any dip like this, no dip. It has been consistently increasing. That is what happens with a new technology in a growing economy. What is Digishala? Digishala is a free TV channel to promote digital payments. It is an initiative of MeetY. Vittya Saksharta Abhiyan, initiative of Ministry of Education to promote digital payments through students studying in higher educational institutions. Digital Intelligence Unit and TAF Corp are initiatives of Ministry of Communication basically to tackle the nuisance of unwanted calls and SMS, and especially those which try to commit some kind of fraud like OTP fraud. Centralized payment systems. In India, there are two centralized payment systems, RTGS and NEFT. Like I told on page number 33, both of them are owned and operated by RBI. Till now, banks could directly access the RTGS and NEFT, and non-banking financial companies or other non-banks, they were accessing NEFT and RTGS through banks. Now RBI has said that non-banks will also be able to access RTGS and NEFT directly without the use of any other bank. Example of non-banks like prepaid payment instrument issuers like Paytm, or your card networks, those who give credit cards, or the white label ATM operators. Okay, how will they be able to access the RTGS and NEFT? Because RBI is going to open there also a current account. So just like you have an account in SBI, similarly banks also have their account in RBI. Now RBI will also open account for them, and then they can also access RTGS and NEFT. eKuber is the core banking solution platform of RBI. So what used to happen is, up to like 20 years ago, this is SBI. SBI has many branches, right? These are many different branches. Suppose you have an account in this branch, and someday in some other city you go to this branch of SBI to withdraw cash or do some transaction. You cannot do this because your account details were linked to this branch. Okay, the records is there in this branch only. The records are not on a centralized system, so you can't do the transaction at other places. When in India core banking solution was introduced, so SBI created a central database whereby each customer was given a unique account number throughout SBI. Now since the data is stored in a central database, and now you can, all the branches are connected to the CBS of SBI, so you can access your account from any branch of SBI. So just like SBI and all other banks implemented the core banking solution, RBI also implemented a core banking solution, right? And the name of that core banking solution platform of RBI is eKuber. Maximum conceptual topics have been covered till now. Only one or two topics are left which need some conceptual understanding. I will explain them, and most of the other things are mostly about ratification. Okay, so I will upload that class 5B having all those things by tomorrow morning, and then our economy course will be finished.